Okay, so returning to the questions in the case, we have already covered these 1, 2, 3, the entire decision problems. Let me just go back to your page. I have just done some reformatting. This is too much. Right. So if we go back to the top and we look at decision problems. Okay, so this is the original set of decision problems from the investment fund, managing the investment fund. Maybe I should put even this into, but anyway, this we are not so concerned with at this point. What we are doing is taking those same decision problems. I just reduced the font size to make everything fit on one page so that it's easier to understand. Okay, let's move this a little bit out. So we were looking at whether or not something is actively, so same these decision problems, which are actively solved, which are automatically solved. So it's a little easier to understand like this. I had to reduce the font size to put everything on one page. All right, so all this stuff we have done. I have also entered the discussions. We've already finished the discussion. I'm just showing you how I've marked it. Okay, so entry price is active. You understand that? Because the hedging team has the decision, has the choice of, they are able to decide when they want to hedge. So the hedging team, they can decide by looking at a chart. So they can look at a chart and decide how they what time they want to hedge. They know that they are always going to be on one side. That is, the buy-sell decision is automatically decided, but the timing of the entry is up to the discretion of the hedging team. So therefore, this is. Okay, so the entry price is active. Okay, that's why. Now exit price, I've not written anything against the exit price per se, because the exit price decision is split into two: exit with loss, exit with profit. So here, and now what I've done here is, if you see that at the top of this module, I've written that, because to make our to give you the essence of the idea, but without making it too complicated. So we have assumed that this entire discussion about how the decision problems which we faced while managing an investment fund, how the solutions to those decision problems are altered when you're managing a hedge book, okay, to control the risks on a passive risk book. When you're managing a hedge portfolio, how the decision problem solutions are slightly altered, where some of the decisions are automatically solved. So when we are discussing that type of material, we have assumed that this is going to be managed using a static hedging program to make it simpler, okay, to understand the decision, the alterations a little more, because when you start looking at dynamic hedging programs, it's a little more complicated, but the basic logic will remain the same. So the entire discussion here, so whatever I'm writing here is automatic, not applicable. That will become active in the case of a, say for instance, when you look at exit price. Okay, the exit price is automatic because in a static hedging program, once you enter the hedge, you can't exit the hedge. Okay, you only exit the hedge when the position rolls off. When your underlying exposure, the underlying material that your inventory that you're hedging, the inventory is sold by the selling team, so the exposure no longer exists, and then you close out your hedge. Okay, so that you exit. So therefore, again, it's not your decision. It depends on circumstances, so it's to be written as automatic. So everything becomes automatic towards the end on the static hedging programs. But understand that if you're managing a dynamic hedging program, these will become active. Because in a dynamic hedging program, you're actively trying to come in and out of the hedge, like you would buy here. If you're long crude oil on the underlying position, maybe you'll sell here because you feel that it's going to come back down again. Okay, like this one, when this oil strike hit the Saudi oil complex, this price went up but then fell. Maybe you feel that the same thing is going to happen here, it's going to come down. So you would hedge your oil position here, but then when it comes down to 56, if you feel it's going to turn around again, then you would buy it back. So if you're managing a dynamic hedging program, then the same decision about exit price with loss, exit price with profit, all these will become active. But for our purposes, we are discussing it to simplify the scenarios. We're discussing it as a static hedging program. So therefore, the decision making is automatic, because once you enter, you can't unhedge. Once you hedge, you can't unhedge anymore. Right? This is clear, everyone? Okay. So number of units of position size, this will also become, this is automatic in all cases, right? So exit price is also automatic for the same reason. Exit price with profit is also automatic. Basically, you don't get to exit whether you have, based on whether you have profit or loss. You exit in a static hedging program, you exit only when the underlying exposure rolls off. Okay, and the last one is the unit position size, number of units of position size, the last decision problem, on which we spend a lot of time in the investment fund case, where we try to figure out what is the right position size, okay, related to the maximum risk per trade, all those calculations which we did, right? So here the situation is much simpler. Again, so actually I should not have written the answer, I should have asked you, but in my hurry to cover some material, I've written the answer. So number of units and position size, you realize, is automatic, okay, in the case of a static. Okay, you can say here, in the sense that there is a, you know, here we can put in a little entry price. This one should not have the star. Yeah, we can put in a little double star here, okay, and that from that part of the note. Okay. All right. So I'm putting a double star here. Why? Because we are discussing the question of the position size. Okay. And I said that it is actually automatic. Okay. But what we have to look at is, we are talking about a static hedging program, and we are asking the question about the decision problem relating to the position size. So if you go back to your balance sheet, if you go to the balance sheet, right, so let's say we are looking at hedging the oil position. So we have 25 contracts. Our underlying position is long 25 contracts, essentially 25,000 barrels. So it's automatic in the sense that you don't have free rein on it, okay, but at the same time there is some element of, I'll write the explanation later, but first understand what the situation is, right? So remember that your total position, what is the golden rule of hedging? You remember the golden rule of hedging? That is the definition of a hedger. The definition of a hedger, you are giving the definition of a hedger. Not net P&L, net position. Net position? Not realization. Then give her the mic. If we can. Total position? Yes, okay, but what is the golden rule of hedging? Again, you are using net P&L. Again, you are using P&L. You know the difference between P&L and position. So between you and Pulkit, I think you have figured out the answer is there between you and Pulkit. But what is the right way to say it? These are very simple concepts. Huh?
The sum of underlying position and hedging position should be between 0 to 1.
1?
1 0.
Now you have memorized. No, you have memorized it. You know, it should be clear as a concept in your head what has to be done. Now you again memorize. So obviously I will confuse you, to see how good your understanding is. So you have to, instead of reading from your note or memorizing, you should understand the concept in your head and then explain it. You know what has to be done. That because the idea behind, because the definition, it's also connected to the definition of a hedger. The definition of a hedger is one whose first transaction must decrease the total risk. Now you understand, when we did this definition, we had not come to this discussion on the case and hedging theory, etc. But now you understand why in the definition I wrote total risk. I did not write risk alone. I wrote total risk. And total risk is meant to indicate risk on the underlying position plus risk on the hedge position. All the hedge positions put together, hedge portfolio, right? Are you following what I'm saying? Total risk is total risk. The term total is used to indicate that it is the sum of underlying positions plus hedge positions, right? So the total risk has to be reduced, okay, because of the first transaction, right? After the first transaction. So the reason that is basically again consistent with the philosophy behind hedging, that the idea in hedging is to reduce risk and bring certainty to cash flows. It is not to make a profit, right? So you'll see in your textbook there are some discussions about how hedging can sometimes be bad for you because it can reduce your profit. That's actually the wrong kind of orientation, because that's not the orientation of hedging. The objective of hedging is always to bring, if you have increased the certainty of your cash flows, if you have, or your returns, okay, and if you've basically so that is the idea behind hedging, to reduce risk and to bring certainty to cash flows. Then the hedging is giving up profits, having an opportunity loss. That's not to be considered as a negative thing in a hedging context. Are you getting the idea? You're getting the philosophy of hedging. Yeah.
Can we say that when we know that the underlying position will drop money when hedging, so this can be called the golden rule?
No, that's not the golden rule. That is also the philosophy. I mean, that is one of that is the idea that drives your the idea that, because the golden rule relates to position size, it does not relate to risk. It does not relate directly to P&L. That's why when she was saying P&L, I was objecting. The golden rule relates to the position size, not to the P&L. There's a difference between the two. You understand that, right? There's a difference between P&L and position size. So the golden rule relates to position size, but you're right in the sense that that is the thinking that drives your decisions to hedge. Like, why do you hedge here? For instance, I gave you this example, that if a hedging team is looking at this oil price chart and looking at previous patterns, and they see that when the Saudi oil facility was struck by the Iranians, the price shot up and then it started declining. The initial reaction was sharp, it shot up, then it declined to even lower levels than where it was. Okay, so you could actually take a similar view and say that similar pattern is going to evolve. Now you have this shock, okay, and it seems quite likely, I think most people will understand, if you see the Iranians made a statement the other day that they had been speaking to a US reporter, and they said that we are going to strike some US Army facilities, military facilities, not civilians, but in return we ask that you do not retaliate, which means they have already gone. I mean, after this hit, that's a sign of a guy who is basically now scared. Okay, why are you saying that if we ask that I'm not going to hit you, I'm going to hit you, but please don't hit me back. Okay, so that means they're now scared. Okay, and they will be, obviously, if you see how this guy was taken out with such a precision drone strike. Okay, so obviously they will be scared. So now you know. So if you look at it from that point of view, and if you take that kind of approach to analyzing the market, you are likely to feel that there's not going to be any escalation now. Although everybody's saying, oh my God, war is going to break out. I personally think that my view is that the Iranians will now back off, because if they act funny, the Ayatollah might be next. Okay, so they've already taken out the number 2, and then Trump is not somebody you fool around with. That you can see, I think, quite clearly. So therefore you could take this view that the price is now actually going to decline. So coming back to what Shreya is saying, as a hedging team member, what is your thinking? Because you know your underlying position is long. As long as the price is going up, you're doing fine. You don't have to worry. So, but when you feel that now there's a risk of a big drop in the price all the way down to 56, now you're worried because your underlying position will start to lose money if it falls here. So to now stop the bleeding on your total P&L, you will now hedge. Let's say, to take it, create a simple scenario, you will hedge 100%. So you will sell 25 contracts here, so that when it comes down here, the underlying position would have lost value from 63, because remember, your balance sheet is being marked to market continuously. As a hedging team member, you have to visualize that your balance sheet is being continuously updated. Prices are being continuously updated, and you're being all the assets and liabilities are being continuously revalued. So the latest valuation of your inventory of 25,000 barrels is at 63. Now if the price drops to 56, then the inventory will suffer a loss from 63 to 56. So if you have hedged here with 25 contracts, the loss will still happen on the underlying position. That you can't stop. Okay, as long as you have the underlying position. So the underlying position will lose value for 63 to 56, but there will be a corresponding gain on the hedge positions because you have sold 25 contracts. So you will lose 25 on the underlying, you will lose from here to here on the underlying position, but you will have an offsetting gain on the hedge position. So you have basically capped. That's why I kept saying that when you hedge at a particular price, if you hedge 100%, okay, then you are essentially locking in the realization for that asset or liability at that hedging price, because your net result is still that you are long at your inventory is valued at 63. Your total valuation essentially is at 63 because you lose money on the underlying position, but the hedge position makes money because you went short 25 contracts and then it drops. This is clear? So your position, your logic is correct. It's just that that's not what we defined as the golden rule of hedging. The golden rule of hedging is meant to keep you, is an indirect control on risk. It's meant to keep you within bounds so that your position, because your initial underlying position here, and remember again, initial underlying position is always updated with new sales figures, new position, new production figures. Okay, so the initial underlying position will always be updated. But with that, so the rule is essentially that your total position, hedge plus underlying, total position cannot go outside zero and the initial underlying position. So once you understand the concept, don't try to memorize it. Try to understand the concept. Once you understand, you'll get the idea. Okay, if you play with it for a while, you'll get the idea. The idea is to make sure that your position size does not increase too much, okay, beyond these limits, because then what you're doing is you are increasing your risk. If you go beyond zero, if you go below zero, then you are increasing your risk. If you go above 25,000 net position, you are increasing your risk, and that is contradictory to the philosophy, that contradicts the philosophy of hedging, that is to reduce risk. Is this clear? Okay, so why did I ask you about the golden rule of hedging? What was I think somehow the question came up, but anyway, so what was I saying? What was I discussing actually? Okay, the position size. We were discussing position size, right? We were discussing the position size decision problem. So if you want to keep it simple, the reason I said auto is here, this auto answer is only correct. Now let me write this. Auto is, make sure you understand what I'm writing, okay? Auto is only correct if 100% hedging is done whenever the hedging team I'm referring to as HT decides to hedge. Decides to hedge means this entry price. They take a decision on the entry price, okay, that this is the time to enter. Just like here, you analyze this market and you feel, okay, now is the time to enter because the market price is likely to fall. So this answer of auto, as far as this particular decision problem is concerned, this answer is only correct if 100% hedging is done whenever the hedging team decides to hedge, because you have your underlying position. If you have a rule that you are going to hedge 100%, to create a simple scenario that whenever you hedge, you will hedge 100%. So in that case, it is automatic because that position size is 100% of the underlying position, and the underlying position is not decided by the hedging team. It is something that it's a pre-existing, it's like an exogenous variable, is given from outside. Okay, so therefore that's why I'm saying auto. Are you able to follow that? Okay, if partial hedging means that I don't hedge 100% of the position. Okay, are you following that? If partial hedging is done, then the DP is decision problem, is being actively solved. Okay. So to understand this decision problem of number of units or position size, because whenever you transact, that is one of the decisions you have to take. How many units do I sell or buy, right? So that's a decision. So if you have, so I've written it as auto with this qualification here. It's auto is only correct if 100% hedging is done whenever you hedge. In that case, it's automatic because you're 100% of the underlying position, which is predetermined. So there is no room for you to decide anything. Okay, you can have, this again can come out of your risk management policy. The risk management policy document will specify all these things. Whether the hedging team has discretion to do partial hedging or not. Because company, if it's very conservative, it might say that if once you decide to hedge, you hedge 100% and it's a static hedging program and then you just forget about it. The advantage of that kind of approach is that it saves you a lot of time. You don't really spend too much time following the market and all that, right? You just finish your hedging in one shot and that's it, you're done. So in that case, it's auto. But if your policy allows you to do partial hedging, in that case here, what I might do is, instead of selling 25 contracts, I may sell 10 contracts. Okay, because I'm not very sure that it'll actually go down that much. So I'll sell only 10 contracts. And then I'll wait and see. In this case, this decision to choose 10 out of 25, I could have chosen 12, I could have chosen 9, I could have chosen 6, I could have chosen 17. So there's a lot of choices available. So here we have to say that the decision regarding the solution to the number of units decision problem, number of units position size decision problem, in this case we have to say it's active, because here the hedging team is using its discretion. Are you following? Because if you have a system where you're allowed to do partial hedging, then partial is what partial? I mean 10%, 15%, 25%, 35%. That is all to the up to the discretion of the hedging team. And so therefore we must say it is being actively solved, because they're actively choosing to decide some percentage. 10%, 35%, 85%, could be all kinds of choices. Are you clear? Is this clear why I'm saying this? So it is auto, but it could also be active depending on whether or not the policy talks about 100% hedging or not. If the policy allows you to do partial hedging, then the answer is active. So I'm just going to highlight this so that everyone's clear about this. Have you followed what I'm doing here? Okay, why I've written this in this manner. Okay, all right, so that finishes our decision problems, and we are not going to deal with these initial and pyramiding. This plot is the question of pyramiding will not even arise in the case of passive risk books and running a hedge portfolio, because pyramiding means again you risk going outside your golden rule. If you start pyramiding, means you're adding to your positions, then you'll go outside your golden rule. You'll be going outside the limits of zero and the initial underlying position. So pyramiding is not even applicable. I've written NA like this. Actually NA should be without the full stops, without the dots here. NA stands for not applicable. Okay. All right. Okay. And initial position, basically here, that we have already discussed. This is what we have discussed. When we talk about these solution methods, automatic or active, we are referring to the initial decision. Okay. So that's basically already covered as above, right? Okay. So that finishes our discussion of the of question number 3 in the case, right? Question number 3 is the decision problems and a discussion of the decision problems to get an understanding of how. So if you do this exercise, it will give you a good idea about how hedging differs from running a spec book, which is what you have done in your first 2 projects, where you've run a spec book, which is a speculative book, okay, an investment fund, where you could see that decision problems will be solved in a slightly different way. And once you go through this detailed exercise and go through step by step to understand how it is solved, it will also give you a very good understanding of how the hedging, how classical hedging should be done. And surprisingly, many companies, even listed companies, don't follow this kind of a rigorous process. They are just kind of doing seat of the pants. You know, like sometimes they may, like I told you about the JP Morgan London whale disaster. So essentially what they did in the London whale disaster is that they violated among other things, they violated the golden rule of hedging. So they went on the other side and basically went, it's the equivalent of going below zero. Okay, so that's why they ended up losing, and it was an illiquid market, so they ended up losing more than $6.3 billion or so. So that is because, so you can see even a big, massive bank like JP Morgan, probably one of the biggest banks in the world, made a mistake like that out of its London investment office. So this is why these principles are important to understand. Okay, so now we'll go on to the last two questions. 4.1, 4.2, and then 5. So these three questions essentially relate to what we call swaps. Okay, so if you remember, we have discussed all kinds of stuff. We have discussed so we have covered, let's see what kind of instruments we have covered. You have exposure to spot instruments because you have traded in spot equities on the NSE. Okay, you have exposure to options because you have traded US equity options. You have exposure to futures because we have discussed futures and you're trading futures in this project. Okay, the one product that we are not going to have time to cover properly is forwards. Okay, we are not going to have time to cover forwards. Forwards are fairly similar economically to futures, but there are some differences. There are differences in terms of the timing of the cash flows. The essential difference, if you understand, between forwards and futures, if you once you understand that forwards are an OTC product and futures are an exchange traded product, so then immediately all the differences that you have seen between OTC and exchange traded come into play. They all apply to forwards versus futures. Okay, so essentially forwards, what you are not going to have in forwards is this daily settlement. When you have a forward contract, okay, so if Citibank enters into a forward contract with ICI PLC, let's say it's a 5-year forward contract to sell sterling against the US dollar. In that case, the only cash flows that are going to happen are after 5 years, because transaction date is today, the settlement date is 5 years later. So in the case of a forward contract, the only cash flows that are going to happen is at the end at the end of 5 years, when the settlement happens, when the exchange of assets has to take place. Remember, settlement date is a date on which the exchange of assets takes place, and a transaction in a financial market is a contract to exchange assets. Why? Because you see how everything is connected, because the financial market is a venue for exchanging assets, one asset against the other. So a contract, are you following? People are looking a little bit blank. You remember all this stuff you did in IPM?
Yes, sir.
That's why everything is connected. Okay, all the concepts are connected. That's why I don't really teach them as 3 separate courses, although officially it's 3 separate courses. Actually, the material is all connected. Okay, so a market is a venue for exchanging assets, one asset against another. A contract in a financial market transaction is a contract to exchange assets. You've done contract law in lab. When you enter into a contract, there are mutual obligations.
Yes.
And when you fulfill those obligations, you're discharging the obligations, right? So you have to discharge. In this case, your contract is to exchange assets. So you discharge those obligations on the settlement date, when you deliver the asset that you sold and you receive the asset that you bought, and the other party fulfills its obligation to deliver that asset to you. Yes? So you have a contract to exchange assets. On the settlement date, you must discharge the obligations under that contract. So you have to connect everything to law as well. Whenever possible, you have to connect everything to all other disciplines. You have to see it from a multidisciplinary perspective, because in real life, that's how it works. So in the case of a forward contract, all that's going to happen is the only cash flows that are going to happen is on the settlement date 5 years later, the assets will be exchanged. So ICI PLC will be selling sterling and they will be receiving dollars. So Citibank will send them the dollars and ICI will send them the sterling. Is this clear? So 5-year forward contract to sell sterling against dollars. So in between there are no cash flows. That's the difference in a forward contract. But if you do a futures contract, which you want to keep on rolling over for 5 years, remember a futures contract is exchange traded, right? So if it is exchange traded, then what happens? If you remember your own, exchange traded contracts, you have an exchange clearing house. This guy wants to collect money every day when you lose money and pay you money every day when you make money. So therefore, on a futures contract, if you did the same thing with the sterling futures contract, right? You can go to your You can go here, you can set up, I think, let's see what the ticker is, maybe GBP itself. If they give, yeah, so if you have British pound futures, right, let's say we look at March futures now, okay, let's look at March futures. So you have GBP March futures, these are expiring on March 16th, 2020. Now, if you enter into a transaction, of course I couldn't take a 5-year futures contract because they don't trade that far out, but if you enter into a transaction here in this futures contract, this is going to expire, although this contract, actually the final settlement for this contract is 16th March, okay, but there are going to be cash flows in this contract every day from now to 15th March, because every day if I sell sterling now here, and then depending on what happens to sterling, if I sell sterling today and then tomorrow's price is say 135, that means I've made money or lost money. If I sell now and the next day's price is 135, I lost money. So I have to pay this difference, about 300 points, right? So I have to pay whatever number of contracts I've sold. This one I think is 125,000. You have to look up the contract size. I think the contract size is 125,000 pounds. Okay, because remember it's a futures contract, exchange traded, therefore standardized contract terms. Okay, so there's a standard size, so you just sell one contract in whatever the size that is. So that into that 300 points difference, I have that big a loss. So next day I have to pay that loss to the exchange clearing house. This guy is going to collect from me here through my clearing member, goes to the exchange clearing house. He passes on the loss. My loss is the other guy's profit. He takes this profit, my loss, and he passes it through the other clearing member on to the other guy, right? Remember? Okay, so this is what this means essentially, is that in a futures contract you're going to have cash flows every day because of the fact that a futures contract is exchange traded. So there's daily settlement of profits and losses. All right, that is the essential difference between futures and forwards. Otherwise economically they are the same. Essentially economically they're the same, but obviously the cash flow timing differences do have an impact. Okay, so because you have to fund those losses.
In forwards we set a particular price for the next 5 years, and if the
could be any maturity, yeah,
and if the price at the maturity is above that price, then we have profit, and if the price is less than that, we have to
if you have bought and the price is higher than that, then you have a profit, and then if you have sold, if you have bought and the price is lower, then you have a loss.
In futures we don't set a particular price for the that underlying asset. So then why?
No, that statement is not correct. The statement you made last is not correct. Both are. Let's take a simpler example. Let's take a futures versus forwards here. Okay. In the case of instead of taking a 5-year forward transaction, let's take a forward contract that matures on 16th March. Let's take a forward contract that matures on 16th March. So the only difference, let's say by 16th March, the ultimate price is 145. Okay, and you sell at 131.95, so you're going to suffer a big loss. The only difference between the futures and the forwards is, in the case of the forwards, in the case of the forward contract, you will realize that loss in one shot at the end, because in between there are no cash flows, because it's an OTC contract, forward contract. Okay, right? So you sell at 131.95, the final price is 145. The March 16th price of cable, okay, is 145. So you're going to suffer a loss. In the case of the forward, you're going to suffer that loss in one shot lump sum at the end, at the maturity of the contract, because in a forward contract there are no intervening cash flows. Yes, clear? OTC contract, that's why there is risk, right? But in the case of a futures contract, as you know, there is a daily settlement of profits and losses. So when this thing goes, let's say if we draw up a chart from this for this, you can't see much. Okay, anyway, doesn't matter. So here what is happening, if I sell here now, it goes, now as it goes to 145, let's assume for the sake of simplicity that this thing goes in from now to 16th March, it goes steadily up all the way to 145. Okay, in this case what's happening is, in the case of the futures contract, I'm not realizing the loss in one shot at lump sum at the end. I'm realizing the loss in small bits and pieces every day. Because today it goes from 131.96 to 133. So I'll have to pay the difference between 133 and 131.96. But now I'm short at 133. So if the next day it goes from 33 to 34, I'm paying only $1 cent actually, 1 US cent. Okay, are you following what I'm saying? So in the case of and so on and so forth, all the way it goes to 145. The total loss, if you ignore the interest cost of it, if you ignore the time value of money, then the total loss is the same. The difference in the case of the futures is you're realizing it in bit by bit, day by day, in small chunks, all the way to 145. Are you following? The realization of the loss. In the case of the forwards, you're realizing the whole loss in one shot at the end of the contract. Yes? Clear?
So this loss is in the forward, it is dependent on the fixed price. And
no, in both cases there's a fixed price. In both cases you're going short. Let's assume that they don't have to be exactly equal, but let's assume that the futures and forwards they will be more or less close to each other. So if you look at a forward price because if you look at, now let's look at GBP USD spot. Okay, now you see the differences in is there a difference between the spot and the March 16th futures price? Market is the same. When we are comparing this with this, the market is the same. The market is still cable. Yes? Market is defined by the two unique assets. If I am pricing gold in US dollar terms, like here, gold in US dollar terms, that's a particular market. Okay? But if I start pricing gold in yen terms, now the terms asset has changed. Now from US dollar it's gone to yen. Now that's a different market. Anytime you change one of the asset, it becomes a different market. But here the asset is the same. I mean the market is the same. Between this and this, the market is the same because both are GBP USD. Okay, so this sterling futures, this is against the US dollar. Okay, so I'm telling you that. Okay, and this obviously you can see is GBP USD cable, spot cable. Both cases the market is the same. Yes, but the instruments are different. That's why you have a framework like this which talks about markets and instruments. So here under currencies, under spot, in this box, you have to imagine all the possible currency pairs in the world. Turkish lira against Japanese yen, everything you can think of. NC2, using the permutation combination philosophy. In this box you have to imagine that there are so many markets which is equal to NC2 with n equal to maybe 169 or whatever number of currencies in the world. Yes, you remember all that? Yes? Not getting a clean answer. That is how you're supposed to use this framework. I can't draw all this here because I can't magnify so much. But you have to remember that in this box there are NC2 markets where let's say n is equal to 169 number of currencies. That many markets, okay? Nigerian naira against South Korean won. Every possible combination you can think of is located in this box. You have to imagine that. Yes, Parul, what is your question? Maybe you can use the mic. Yeah. Are you following so far?
Yes, sir.
Okay. What happened to Aurora? She's knocked out. Can't handle it. Didn't sleep enough. Yes.
Can we go back to that
Yeah.
in this GBP, the other one, second last. Sir, the transaction will not end when we have sold the asset. Like why we are comparing it to the next day price?
Because it's a futures contract. It's a futures contract. So what is a futures contract? It's exchange traded. The moment you see futures contract, immediately a bell should go off in your head saying it's exchange traded.
So if we have sold and price goes up, it is a loss. And if it
Next
goes
day,
down, then
you have a profit.
But if we don't have sold any position and we have we are on 1.315, the situation is reversed. Like if they goes up, then we have profit. And
no, if you have not done any transaction, then how can you have a profit? You just said that if you have not sold,
we can sell it to a higher price.
yeah, if you have not sold now, if it goes to 135, then you can sell it at 145. Yeah, that's correct. That's fine. But we are considering the example that I was talking about to show you the difference between a forward contract and a futures contract. That's what I was trying to illustrate, right? So I was saying that since this particular futures contract matures on 16th March. So let's take an example of a 16th March forward contract in comparison, okay? So the difference that will happen is, and let's assume that the price of the futures and the forwards is the same. It'll be more or less very close to each other. So if I sell forward at 131.95, then and the final price on 16th March is 145, then this loss between 32, let's say 32 and 145, 32 and 45, the difference, that loss in the case of the forward contract, I will realize that loss in one shot, lump sum at the end on 16th March. Yes, because there are no intervening cash flows in an OTC contract in general, okay? But in the case of the futures contract, if I sell this now at 131.95, if tomorrow's price is 133, I'll have to immediately pay the difference between 131.95 and 133. And then the next day's price is 134. Then I'll have to pay the difference between 133 and 134. So the difference is, eventually the total loss, if you ignore the time value of money, the reason I'm saying ignore the time value of money is that moment on the first day you have to pay, say, 132 to 133. That loss has to be funded. So you have to take the interest cost of that funding. You have to pay that amount, right? Where's the money going to come from? You have to borrow that money and pay it. So you have to pay you have to consider the interest cost on that borrowing. That's why I'm saying, to keep it simple, let's forget about the time value of money. But if you forget about the time value of money, your total loss in the case of the forward or the future is the same, from 131.95 to 145 in both cases. The difference is, in the forward case, you are realizing that loss in one shot lump sum at the end. But in the case of the futures, you are realizing that loss bit by bit, little bit every day. So that eventually on the first day it goes to, where's this? Yeah, on the first day it goes to 33, so you realize this much loss. Next day it goes to 34, you realize extra loss of 1 cent. Then it goes to 36, then you realize a loss of 2 cents. Day to day you realize small chunks of the loss. The total loss comes to be the same, ignoring the time value of money. Is this clear? This is the difference between till the maturity?
16th March.
Yeah, maturity is 16th March. Right? So that's the only difference. So you understand now the difference between forwards and futures. Economically they are the same. If you ignore the time value, but you can't of course in real life ignore the time value of money, because that matters. So therefore there is a problem in equating. That's why you can't always say that futures and forwards will always have the same price. Okay. Theoretically they should be very close, but there is not. It's really, strictly speaking, not possible to arbitrage the difference, if there's any difference, because you don't know how the loss pattern is going to evolve in the futures. That maybe you have to pay a certain big amount, and maybe that day the overnight interest rate is very high, because every day you're borrowing overnight, right, to fund the loss. That day if the interest rate is too high, okay, then you have to pay a huge cost. So basically you can't predict in advance. You can't do classical riskless arbitrage here, because you can't predict in advance all the cost. Some of the cost is unknown because you don't know how the interest rate will evolve. But this is the essential difference. You don't need to get into all those complications. The main difference you have to understand is, I'll come to the questions. The main difference you have to understand is that in the case of the forwards, remember this example, right? You did the same transaction, you have the same total loss ignoring the time value of money. In the case of the forwards, with OTC instrument, you realize the loss lump sum at the end. In the case of the forwards, you realize the same amount of loss, but bit by bit, small amounts every day. This is the difference. Daily settlement of profits and losses, because futures exchange traded. Yeah. Oh, sorry. I'm saying it so many times I'm getting confused. Yeah. So essentially, futures exchange. Just remember, futures exchange traded, daily settlement of profits and losses. Forwards OTC, one-shot settlement at maturity date. Okay, that's the difference. Sorry, I wasn't even aware. Now I tell you guys to be aware of what you're saying, but I'm saying it so many times that I'm forgetting. Yes, Saloni, what is your question? We'll come to Mehak after this. Yeah.
It's a daily settlement, it's a consolidated, and futures is forwards is consolidated.
Yeah.
The settlement at the end.
At the maturity. majority, right? That's it basically.
Interest cost is in both the transactions.
Sorry, come again?
The interest cost which the person has to pay, that's only in forward or in futures also?
No, interest cost, you see, even in the case of the forwards, you have to pay the interest cost. But in the case of the futures, what's happening is, but you pay that at the end. You have to pay that at the end if you fund that loss, right? When you fund that
It
loss,
would be net interest cost.
what do you mean by net?
Profit on my forward contract. So now the other company has to pay me that money.
Yeah.
The firm is taking.
No, the other company will not pay you. What the other company will do, let's say, let's look at the forward contract. If you have sold cable at 131.96 for 16th March settlement, and then on 16th March the price of cable is 123. Let's say the price of cable is 123 here. On 16th March the price drops here. Since you have sold here and the market price on the settlement date is this much, you make money. Because under the contract you can sell cable at 131, at 132, and you get a much larger number of dollars. You get $132 for each pound. Let's assume the transaction is for £1 for simplicity. So he sold 1 pound at 132 for 16th March, and on 16th March the actual market price is 123. Okay, so what happens, you sold pounds and you bought dollars, right? And on this day it is 130. Under the contract you are selling pounds at this rate and you are buying dollars. So here what is happening is, at 123, when the market price is 123, you can buy essentially with the $132 that you're going to get. Okay, you need to spend only 132. So just try to understand how the profit cash flows work.
Right.
Because you are going to get $132 under the contract, and you will sell -1 sterling, but plus $132. On the corresponding side, on the market side, you take that. Where do you get that sterling from? You buy it in the market. You buy it in the market. It costs you only $123. Okay, so you have the difference between 32 cents and 23 cents. That will remain in your dollar balance, because the sterling side will cancel out. You will buy 1 sterling in the market, spending $1.23. Are you following?
Yes, sir.
You will buy 1 sterling in the market and use that sterling to deliver against your short position in the contract under sterling. You have to deliver 1 sterling. You will deliver that 1 sterling, buy it in the market at 123. But when you deliver that 1 sterling under the contract, you are given 132. So 32 cents minus 23 cents is the difference. That difference will remain as a plus, as a credit in your dollar account. Yes, are you following? So you made a profit. So this is how the profit works, okay? Because you get delivery at the contract, and then and the flip side, you have the same problem on the loss side. Okay, this is how it works. Okay, so don't worry so much about the interest flow at this point. It might confuse you. Just focus on the. If I take it here, does it still? It's going out a little bit. Okay. So anyway, just focus on the fact that the loss realization is in bits and pieces in the case of the futures contract, and it is it's in bits and pieces in the case of the futures contract, and it is it is lump sum in the case of the forward. Okay, so since it's important to have the discussion, because we are not going to have time to cover forward contracts. There are only 2 sessions left. So these are the instruments that you have covered, but understand this once again, visualization, how to use this framework. Inside this box there are NC2 markets. Okay, all kinds of currency combinations you can think of. Okay, South African rand against Canadian dollars, everything you can think of. NC2, same thing here. If the contracts exist, somebody has to put it on in the exchange. Some exchange has to put it on as a contract, but theoretically it's possible. Okay, same combination, NC2. Theoretically it's possible to have futures contracts. The difference you can see is prices are not the same. Market is the same, cable, GBP USD is the market. Market is the same, but this is spot and this is futures. Are you following the scheme? And therefore you see that although the market is the same, because the instruments are different, then therefore the prices are also different. Is this clear? Can you see that? These prices are different. Okay, if you want to see another thing, if you see let's see how far forward they have the futures. I'll give you yeah, they're not listing beyond March because it doesn't really trade that much far out in the futures contract. Okay, so anyway, but technically theoretically you can go further out, okay, and you'll see further differences in the price, because here the settlement date is different, and this is again reflecting the time value of money. Can you see that? Because this spot settlement, this will have to be settled after 2 days. Okay, this will have to be settled after 2 days. This is settling on 16th March. Okay, so the settlement date is different. Ordinarily you would expect the price of the instrument to be different. Okay, the market price, and you can, as I said, every time you see a market price, it's a price of some instrument or the other. This is the spot instrument price, this is the futures instrument price. Okay, clear? Now we are going on to swaps. Yeah.
So USD, GBP and GBP USD are two different markets, right?
No, we would not treat them as two different markets. The order of the currencies is not different. We would treat them as the same market. But the convention is to have GBP as this is just a convention. The convention is to have GBP as the base asset. So you would only call it a different market if you change one of the assets. In this case, the market is the same. Huh?
I'm talking about that only, that in one case USD is the terms asset and in second case GBP is the terms asset.
No, but you have not changed any of the assets. You have flipped around the order of the assets, which is being shown first. In this case, you write it as, but nobody trades USD against nobody trades market convention, because we have to also be anchored in the markets. So the way we define a market is the two assets have to remain the same. Because very often what happens is, even in this spot GBP market, okay, in the sense the convention is to trade in terms of the base currency. So in the foreign exchange markets, if you're asking for a price between dealers in the OTC markets, the convention is your round amounts of 1 million 1 million units of base currency. So if you're trading cable, normally you should be asking for a price in 1 million sterling, 2 million, 3 million, 10 million sterling, etc. So in that case, you would just write it as GBP 10. If you're asking for a price in 10 million sterling, you would just write it as GBP 10, because everybody understands that it is 10 million, okay, million units of base currency. That is the convention. So now nobody trades, but in that market also, the reason it's the same market is that in that market also, sometimes if a corporate has a requirement to trade in US dollar amounts, so they can say GBP USD, they can call for a price and say GBP USD in 10 million USD. So in that case, because they are departing from the convention, so they have to specify the amount that clearly. They have to say GBP USD in 10 million USD. Otherwise, if you are just going by the convention, which is to quote to trade in terms of million units of base currency, in that case, you just ask for if you want to trade in sterling 10 million, you just say GBP USD for 10. That is understood as base currency units, million units of base currency. But if you want to trade, you can do that also. You can call a bank and say, I want a price in GBP USD. You would say cable actually. You would say, I want a cable price for 10 million USD. Now you have to mention it because you want to trade in terms currency amount. That is not the convention, right? So if you like, it's in here we buy bananas by the dozen. If you want to buy bananas by weight, you will have to tell him, you have to specify that, you know, I want to buy it by weight. So whenever you're departing from the convention, you have to make it clearer with additional language. But the market remains the same. The market only changes when you change one of the assets. Is it clear? Okay. All right. Okay. So let's go on now. What we are going to do is we are going to go on to, so what you have covered is you've covered spot. Okay. You've covered futures. We have some idea about forwards versus futures now. You've also covered options. Now what we are going to do is we are trying to cover swaps. Okay, so let's first get into a taxonomy of swaps. So we have a note which I think should be in your folder. Maybe it's in the, if it's not, I'll put it in there at the end of this class. Yes, it's there. You have a technical note on swaps in your case, because some of the questions in the case relate to swaps. These last three questions in the case relate to swaps, 4.1, 4.2 and 5. All right. So now we're going to cover swaps. So let's look at the technical note on swaps. This is okay because we made this. Now we'll just make it bigger. This is a problem with Chrome actually. They should fix it. If I increase the zoom for one tab, it just changes for all the tabs. And in Firefox it's not like that. In Firefox you can change the zoom for one tab and it doesn't change the zoom for the other tabs. But in Chrome it seems to be like this, that everything changes in one go. Okay, where is this futures? Is this I think this is the one for swaps. Yeah, okay. So let's go to swaps. Okay, so let's first be clear about the what is the zoom here? Yeah, okay, finally we have 100%. I'll make this. So for swaps, the two references that you're going to use, I'll give you some references. Here you can see chapter 7 on Halbasu. It says 9th edition here, but it's 10th. You guys have 10th. The edition, it doesn't change actually. If I go here, I can see that chapter 7 is swaps. Okay. Maybe it's not 100. So you can read the introduction of the swaps thing. But let me first give you a proper taxonomy of swaps. That's very important. You understand taxonomy? The science of classification, and is also used to refer to a particular classification. Okay, so if I classify the students on this campus into law students, MCA students, BCA students, some people are PGDM students, some are English students. Okay, so that's a classification that we would call a taxonomy of BIP students. Okay, we have taken all the students and we have put them into certain classes in categories. Yeah, okay, so that taxonomy is very important because otherwise you don't get the right perspective on a field, and you also have to use the right terminology. That is very important because it affects your understanding of the material. Okay, so now the problem that we have is we are basically looking at two types of swaps. Okay, we're looking at what we would call capital market swaps. Where have I written this? Okay, let's refer to your also refer to your have I referred you to let's refer to your working note. This is also important. Okay, here in your calc file, yeah. So what we actually want to do is we want to classify, yeah, this is the high level classification. Okay, we want actually this should be FX swaps we'll call them. This classification should be in this note. Yeah, okay, so let's call them FX. We can call them FX swaps, so we can also more correctly call them this is the FX swap structure, but let's call it, there's a better way to define it. Okay, because we will there's a better name for it actually. We'll put this at the end. Example as FX swaps. All right. So now first understand how the market refers to these products. Okay, so we are going to basically, this is going to be our high level taxonomy. Okay, we'll call them capital market swaps. Okay, and we're going to call them, this is going to be a high level taxonomy. So all swaps are divided into capital market swaps and position maturity altering swaps. Okay, so for swaps you can also refer to this book. There's a very long discussion on swaps and swap options and all that. You can refer to here under interest rate risk management. You can look at all kinds of interest rate and currency swaps. Okay, your syllabus is whatever I actually covered in the class, but if you want to read up on the material, okay, you can read up, if you want to read up on all kinds of exotic swap structures, you can read up from here, swap and option structures covering interest rate risk management and swap and currency risk management. And don't worry about the fact this book was written in 1993, but everything is still 100% relevant because the products have not changed. So the book deals with the product features and the product application. So this is still 100% relevant because if you remember, actually, when we teach you contract law, when do you think that law was written? That law was actually codified in from like the 1200 or 1250, 1300s in the UK. Eventually it was written and codified in India in 1872 as the Indian Contract Act. And we haven't really changed it much. So we are actually still working with the law of contract, which evolved even earlier than 1822 and was codified in India in 1872. So the fundamental principles don't change, you know. So when you see some of your conclaves, people come and say, whatever you learned today, it becomes irrelevant tomorrow. Those are kind of superficial statements because the fundamental principles don't change, okay. You can see this, everything, I checked it once because I wrote this in 1993. Now everything is 100% relevant because none of the products have changed, okay. One or two new products have come, but all the products are covered here, I mean at whatever was available at that time, and nothing has changed, product features, so it's still 100% relevant. So you can use this for further reading, and it will also be useful because lots of graphs are provided here in this book. And you can also use the chapter 7 for swaps, okay, and then I'll give you this. But what you will not find in any of the books is this kind of a taxonomy, which I think is very important, which is to understand that this is the, let's see what the color is here. So under this orange, the third one, okay. All right, so this is your basically these are the two types of swaps. So is this clear? It will become clear later on in terms of what they actually are, but first understand the taxonomy. This is the right way to classify it, okay, because this capital market swaps, which and give this a little bit of, we're losing the connection. Are you following what we are doing here? This is referred to, so I'm going to use two. What we are doing here is the terminology used in the market is not accurate, in the sense it's not a good terminology. So I'm giving you a taxonomy which is the right way to classify it, which gives you the proper distinction between the two products. So what we are doing is the two types of swap contracts that the market refers to are these, right? So the market uses, are you following me here? Okay. So let me just tell you, so you need to be familiar, so you have to study at two levels, okay? Just like when I taught you arbitrage, I taught you what is classical riskless arbitrage, and I taught you all the other various uses like uncovered interest arbitrage, risk arbitrage, statistical arbitrage. All are terms used by the market. So if you see these terms, you will not understand that they are actually not arbitrage. So you have to be familiar with the market's terms, and you have to talk in the lingo of the market. So when you're talking about statistics, you'll have to use the word stat arb, okay? But you should know in your mind that this is not true CRA because it is risky, okay? It contains, I mean, it retains market risk. So similarly, I'm going to teach you first the lingo of the market, and then I'm going to show you why the lingo of the market is not correct, and I'll show you what the correct taxonomy is. So you will have to have knowledge at two levels: understand and speak the lingo of the market, but also theoretically be clear why that classification in the market taxonomy, the taxonomy implied by the market's language is not correct, okay? So first, the market's language. Market talks about two types of swaps. Basically, they say swaps. When they say swaps, they are referring to these kind of transactions. They are referring to these interest rate and currency swaps, okay, such as these kind of swaps, basis swap. All these interest rate and currency swaps is what the market is referring to as swaps. When they use the term swaps, the market is referring to all these kinds of interest rate and currency swaps, which you can see discussed in chapter 1 over here, okay? This you will find in your finance reference folder from your IFM days, okay? Now, and the other term that the market uses is what we have called It's a long name, but it's the correct name. It tells you actually what is happening here. So the other name that the market uses is FX swaps. The other context in which the market uses is the word swaps is FX swaps. Okay, so this is the basic classification: capital market swaps and FX swaps. Markets classification is swaps, which is referring to interest rate and currency swaps, and FX swaps, which is referring to these foreign exchange swaps. Okay, but the true classification should be that one should be called capital market swaps. One category should be called capital market swap, that is these kind of instruments. These should be called capital market swaps. We still have some time, so don't get restless. So these kind of instruments, which are very commonly used, interest rate swaps, currency swaps, which is what you will see discussed when you go to your Hull chapter. When you go to your Hull chapter in swaps, this guy is actually discussing these interest rate and currency swaps. Okay, he's discussing these products, interest rate and currency swaps, which are again market terms that are used. Okay, so all this stuff that he's talking about, interest rate swaps, he's talking about this stuff which the market calls swaps. Okay, and then he does not really discuss FX swaps in this chapter. Okay, so but what we are saying is that we will classify as two different categories: capital market swaps and position maturity altering swaps, which we are not going to have time to discuss. Okay, so we are going to just discuss one category, which is also required for the answers to our questions. So if you look at these questions in the case, these last three questions in the case, these are basically, these relate to the type of products that are covered, what I'm calling capital market swaps, okay, and which the market calls swaps, which are normally referred to, the types of instruments are interest rate and currency swaps. You can read here chapter 1. It'll be good for you to read a simpler version. Maybe you can start with this book first and then go to Hull, because this is much simpler. Okay, but although it covers, no need to cover all these various complicated versions, but just the initial interest rate and currency swap structure. So this is what we are going to cover. Okay, so I'm not going to spend too much time on the taxonomy. The reason I'm calling it capital market swaps is because they were usually issued and they're always connected to some kind of capital market transaction. You understand capital markets? Raising money either through debt or equity. In this case, these are all connected to debt. Okay, we don't connect it to equity issuance, so they're all connected to some kind of debt issuance, but we are just using the general word capital markets. So that's why I'm calling it capital market swaps, because they are they're always connected to some previous or current issuance of capital market instrument. Okay, so now we have a little time. We'll make a small start. Okay, I want to cover, because we have a little short on time. We have to finish this. 1 minute. I'm watching the time. 1 minute, guys. So we forget about FX swaps for this part because we can't cover it. Let's try and understand. We are only talking about what the market calls swaps, and what we are deciding to call capital market swaps. They are also referred to by the market as interest rate and currency swaps. But what I'm going to say are all are interest rate swaps. Okay, a swap is basically going to be like this. Okay, basic structure of a swap. Please read properly. Okay, read from this book. See the pictures. Try to understand. Same pictures I've drawn here. A swap is always like this. ABC is the company. ABC is the company, and SCB is, say, Standard Chartered Bank. There are going to be two counterparties. There's a transaction, market transaction. There'll be two counterparties, pretty obvious. Okay. Now there are going to be some flows. Okay, there'll be a period of time that is fixed. Could be 3 years, 5 years, 10 years, 20 years, whatever. And there are going to be periodic exchanges of interest payments. Okay. Now, in this particular example, I have considered this example where you have ABC is making a fixed interest rate payment, and Standard Chartered Bank is making a floating interest rate payment. Okay, so we will discuss this now. The time is up, so I won't hold you back. But please go back and read, because we need to cover swaps in the next class, because these last three questions in the case relate to interest rate and currency swaps. Is this clear? We are going to cover. Please cover and read it. Read the chapter 1, I would say. We have to really So I'm actually going to do, what I'm going to do is I'm going to run the video a little bit longer so that you have an understanding of so yeah.
I want to ask one thing.
Yeah.
So why would anyone then choose futures? Because futures they always have to worry about constant payment and they'll have to keep some money aside.
Yeah, good
But
question.
everyday payment
Good question. But
some losses.
remember, what are futures? Futures are exchange traded instruments. Why do you choose exchange traded instruments as opposed to OTC? What might be your motivation?
So that the clearing house is there in between. So
Low, what do we say in technical terms? You are,
security that
yeah, so what is the technical term that we want to use? Because you're not layman anymore, you're finance students. So the technical term that you should
intermediary is there, so there is lack of chance of
So-
the money not being realized.
virtually non-existent. Credit risk, the term that you should be using, the word I was looking for is credit risk. So credit risk, because of the presence of the exchange clearing house, credit risk is virtually non-existent. That's one of the major motivations for using an exchange traded product. Even though you have the headache of daily settlement, but that's what makes you choose, if you're more worried about credit risk than about daily settlement. And there are many other aspects also. There's also liquidity. For instance, if you're trading, let's say you want to make, there's some big news in the Middle East, some action by the US that's going to affect the crude oil price. If you are a speculator, there's also the aspect of liquidity. So in the case of crude oil, so it differs from market to market, but in the case of crude oil, the best market to hit, the most liquid market is the futures market of all the instruments. Okay, rather than tying up a tanker, if you have some special news on the market and you really want to act quickly, what you would hit is the futures market. You would hit the crude oil futures market first, because this is trading all the time, as you can see. Okay, and it's very liquid, so you would hit that first. Now that happens to be an exchange traded instrument. So sometimes you may not be motivated only by credit risk. You might be motivated by considerations of liquidity. Which it differs from asset class to asset class, market to market, depending on how the market has evolved. Certain cases, like in the case of the currency markets, spot currencies are the most liquid. So if you want to hit the currency market fast with big volume, you would not use futures, you would use the spot market. So it differs from market to market, asset class to asset class. But liquidity is also another major consideration, which leads you to the choice of market. It could also be things like customization of contracts, which would take you into OTC markets. It could be considerations of fear of credit risk, which would push you into exchange traded markets. These are the kinds of considerations that drive your decision making. Clear? Yeah.
So that you explained about net P&L, that's the sum of hedging and unrealized positions will be equals to zero. So that is the explanation of holding.
Again, you're using the word P&L.
So it's because you use that.
No.
Many times that's why I'm writing.
No. Maybe.
Everywhere.
No. You don't have to write so much because I'm giving you so many notes.
Yeah, but
So
I
maybe if you want to take notes, you can take. But the point is that I may have said it like today. I mixed up futures and forwards because I've been using these words so many times. But I would not have said no. Read. No, that's why. 1 minute. That's why you should read the notes. What does the note say here? If you look at the note, right, where I think we have discussed the golden rule of hedging in your project in the project brief, right? In the project brief, which I have appended to the end of this.
When you explain dynamic hedging and stuff.
Yeah, this is the golden rule of hedging. So you should read it from here, from my notes. These notes are prepared with the very painstakingly prepared with a lot of care taken to the use of words. So in a class when I was saying this same word so many times, as I made a mistake, I mixed up, and I didn't even realize it that I mixed up forwards and futures. But here when I'm writing it, this is clearly written. So you should follow it from here, not from your notes. So it's not P&L, it's position. The golden rule of hedging applies to position size. You're trying to contain the position size to between 0 and the initial underlying position. That's what. It's not PNL. Right?
So we will write the sum of underlying position, hedge position.
Yeah, you read that.
Okay, we have to
You
write
read
this
it.
only if we
Yeah.
give in exam.
No, you don't have to write this in the sense like, I'm not going to penalize you for grammatical mistakes or something. You should have the basic idea. Obviously, if you write PNL in place of position, now that's a totally different thing, right? So, if you instead of profit and loss account, if you write profit and loss AC or something, that you can do short form and all that, as long as we understand what you're trying to say. But if you write PNL for profit instead of position, if you write PNL, that's not correct. So you don't have to write in the sense you don't have to memorize this. That's why I keep on telling you, don't memorize these things, because I'm not penalizing you for. I'm not expecting you to write beautiful English sentences grammatically correct. I'm just looking for some keywords. What are the keywords here? I've even highlighted the keywords. Net position. Keywords, always look at the keywords. Net position, 0, and initial, and the bounds. Net position and bounds. Okay, so net position has to stay within bounds. That's the idea. What are the bounds? 0 and
Underlying,
initial underlying position. That's it. Now you can write it in any way you want. Okay, so as long as this idea comes across, so your grammar can be all over the place. I don't penalize people for that, as long as the concept is conveyed. Is this clear?
This concept was like which you explained on that Excel sheet. On the Excel sheet you explained this concept. No?
Yeah.
Hedging plus underlying position that was coming out to be 0. So that's why you might have used net PNL many times. That's why I wrote everywhere.
No, net PNL I would not have used in this kind. I don't think I'd make that kind of mistake so many times,
watch
because
the video again.
no, you watch it and you find, if you find something where I'm talking about PNL and talking about the golden rule of hedging, I doubt I would have done that, because I don't think I'll make that kind of mistake so many times. Only now, today I might have made that mistake once.
I have written on all 3
No,
to
that's
4
why you should
pages.
refer to, these notes are being given to you, you should refer to the notes when you have a confusion.
Whatever you teach in class.
Yeah, no, that's fine, that's
I
good.
just refer it at the end of the.
That's good that you're learning from the class, that's fine. But that's why I'm saying that maybe you don't need to take so many notes, because the notes are available to you. Most of the stuff that I'm writing you can take. If you're taking it, it's fine, that's a good thing. But at the end of the day, you must refer to the notes I've given you, because there I won't have any mistakes. I mean, if I have, I'll be able to correct it. Right?
I'll let you know if you are.
Yeah, and then here make sure that you guys follow from here. If you read interest rate and currency swaps from here, this is what we are going to cover. Okay, the various types of interest rate and currency swaps. You can see the structures over here. They're nice diagrams. It's very simply written. So from here you can understand. Okay. So we're going to cover all this in the next class. So we have very little time. We must finish the discussion of the case. We have only one class left. So
1, 2 and 5 also.
yeah. So right. But at least are you able to follow the discussion as relating to the case? You are able to follow it. Okay.
It is easy to follow from the case.
Yeah, but from the case, sometimes when we go into the discussion of decision problems, we have to go into another page, because we are writing so many things, right? So we have to go into the other page because we are writing so many things. So we are going into decision problems, so we have to go here and look at them. But we always have the reference of the case. You are able to follow the case.
So you'll give not this, but like different case in exam also. Like we have to do like this, prepare like this. No case format.
Yeah, I mean you're talking about other subjects.
No, for this subject.
Yeah.
In the exam,
Yeah.
we'll give some case and we have to analyze like this.
There will be a case and there will be some other questions, right? But these concepts, you have to internalize these concepts. As we can see, many people are still not clear about the golden rule of hedging itself, which you are supposed to be aware of while doing your project. So basic stuff you guys have to pick up. Make sure you have basic stuff properly covered. Yeah.
So on day
1 minute. So closing.